like to thank everybody for being here today at our October session of the Buzzards Reaction Committee meeting. Here today we have Rich Zingarelli, the state coordinator for the National Flood Insurance Program with the Mass Division of Conservation and Recreation, who is here to provide an overview on the Biggert-Waters legislation relative to the National Flood Insurance Program. I'd also like to thank Andy Babola from Mattapoisett for helping to facilitate Rich being here today. So I'll bring Rich up, but before he starts, I'd like to just do a quick round table to introduce ourselves to him. And again, my name is Dave Pichette with the town of Wareham.
I'm Mike O'Reilly from the town of Dartmouth.
I'm Dave Fredette, city engineer in New Bedford.
Brian Mulaney from the town of Bourne.
Alan Slavin, Selectman Wareham.
Jeffrey Osich from the town of Page.
Joe Costa, Buzzards NED. Nick Nicholson, town of Mattapoisett.
Andy Babola, town of Mattapoisett.
Marilyn Kelly, Acushnet. Ann Rodney, EPA Region 1 in Boston.
Dave Janik, Coastal Zone Management.
Paul Murphy, town of Dartmouth.
Rich Rion, Prime Engineering.
Dave Fickbox, town of Dartmouth.
Great. Very good. Well, all yours, Rich.
Thanks. Pardon me if I sort of move around funny and sort of having to straddle the cord here since we don't have a remote working. But what I'm going to do this morning is give you some overview on changes that are occurring in the National Flood Insurance Program, particularly related to legislation which was passed last summer by Congress. You may have been reading an article or two in the newspapers about effects that are occurring to people's flood insurance premiums. So I'll go through, give you some of the basics and talk about where there may be some misinformation that's out there and hopefully give you sort of a basis of what's happening. I did bring, if you didn't pick it up when you came in, I have over there a copy of my presentation and then also a single sheet front and back reference guide from FEMA on the Biggert-Waters Act and the changes in terms of premiums. But before I get into that, I just want to do a very quick sort of overview or update on where you stand on your status of the flood insurance maps, because the two can be connected. I know in the papers they're being totally lumped together, and they're two separate things, but they are in some ways connected. And it kind of surprised me when I went through putting this quick update together that with only 12 communities, given that you're in 4 different counties and a couple of the counties have inland communities and coastal communities that are part of your group, we actually have 6 different map status out of 12 communities. So I'm going to go through, basically give you a quick overview of where you are in terms of your flood insurance map status, and then go into the changes from Biggert-Waters. So FEMA has been going through the process of updating their flood insurance maps from the old paper firms that you may be familiar with. Somebody in FEMA used to call them the Hershey bar maps because he said they looked like they were drawn with a melted Hershey bar, the sort of blotchy shaded areas and just showing streets. They've been in the process of updating to new digital maps that have aerial photo, ortho photo as the base, and then the flood zones overlaid on those maps. And then they're also made available to communities in a digital format for use in GIS systems and the like. And as I said, they've been going through county by county doing these updates with an emphasis on coastal areas. So we have active mapping updates in all of the coastal counties. I mentioned having a new map doesn't always mean that there's new flood data, because as part of doing these digital updates, they are in many areas, particularly the inland areas, simply taking the old data and putting it onto the new flood insurance map. So even though you may see you have a map effective 2009, 2010, that doesn't mean that all of the flooding analyses are that recent. They may be back from the old 1970, 1980 studies. So I'll go through quickly, county by county. Start with Plymouth County. As I understand it, there are four year communities in Plymouth County: Mattapoisett, Marion, Wareham, and Rochester. Plymouth County, this part of Plymouth County, got new digital maps that went effective back in July of 2012. And there are new revisions underway for Marion, Mattapoisett, and Wareham that are correcting errors that were discovered in those 2012 maps. Those errors are almost entirely as a result of incorrectly delineating the flood zones with the topographic information that they have with the LiDAR. For whatever reason, the mapping contractor made several errors in those three communities. A couple of places there were fairly significant areas. There was one area, I believe in Mattapoisett, where there was what I'll call a hole that was inadvertently mapped out of the special flood hazard area. So those are all being brought back into the A zone. And there are a couple of areas where it went the other way, where there was a hill, basically, if you will, that was mapped into the special flood hazard area that's now being mapped out. Those three communities, you're probably already aware of it, that FEMA issued what they call a letter of final determination on August 5th. That locks in the new maps, and then there's a 6-month period where the towns have to adopt those new maps at town meeting. And the effective date of those new maps is going to be this coming February, on February 5th. I should have said this at the beginning, but certainly as I'm going through this, I'm open to any question. I'll do questions at the end, but if there's anything that you feel can't wait until the end, feel free to raise your, we're a small enough group, raise your hand, and I'll take the questions as I go along. Next, Barnstable County, Bourne and Falmouth. Your current maps for Bourne were 1999 and Falmouth 1993. And there's a county-wide update currently underway to do new coastal flood analyses for all of Barnstable County. So there were preliminary flood insurance maps that came out in May. There's a formal 90-day appeal period that goes with those that has just ended on October 17th. And the estimate is that FEMA would issue that letter of final determination next January during 2014, and the maps would become effective next summer in July. Okay, for Bristol County, you had new maps that went into effect in 2009 for the entire county. And for New Bedford, Fairhaven, and Acushnet, there are some changes that are being made, some revisions that are being made to reflect the certification of the New Bedford hurricane barrier. Basically, any coastal structure that provides flood protection, actually any structure, levees or things like the hurricane barrier that provide flood protection and remove significant areas from the mapped floodplain, has to go through a process where they're certified, and one of the things that they have to do is calculate the areas where there would be ponding behind those barriers, because not only do they keep the floodwaters out, they can, if you have a rain event that's occurring at the same time, say that there's coastal flooding, they can keep water in until such time as it can either get out by gravity or be pumped out. So those communities are having, say, fairly minor changes, I think with the exception of New Bedford, where there are fairly significant areas being added of interior flooding. And those revisions There have been actually a series of preliminary maps. The most recent of them was this August. There's an appeal period currently underway that would end on November 12th. And the schedule that we've been given by FEMA, which I think given the date of the end of your appeal period may be difficult to meet, is a letter of final determination in December, and then maps becoming effective again next June. So that's one we'll have to look and see if that's a schedule that's going to be able to be maintained.
Are they going outside the hurricane barrier, like in the wastewater treatment plant area?
I don't believe there were changes there, but I'd have to look at that. For any area where there are new preliminary panels that were issued after May 1st, those panels can be found on FEMA's Map Service Center site. They have an area for the preliminary maps, and if you have any questions about what changes are upcoming, that's where you can find those maps.
You said that the appeal period for Plymouth County was August, I think on the chart.
No, the letter of final determination was August 5th.
Yeah.
Right.
As an example, when would the town of Wareham receive that information in order to make an appeal?
No, those maps they're not subject to appeal. They had already had an appeal period that had been gone through, and the letter of final determination essentially locks in the maps. I believe there was no appeal to those maps. If there had been, those appeals have to be resolved. So at this point, they're locked in as of August 5th. They will become effective on February 5th in 2014. And basically the town has to adopt those new maps at town meeting in order to maintain their status in the flood insurance program.
We had a preliminary public hearing Monday,
Mm-hmm.
and the consensus from the people who were present, they don't want the town to adopt the maps. They want the town to reject everything.
That's, okay,
Just want to give you a heads
right,
up.
I understand that. I think I actually saw an article on that, and that is a separate discussion that we certainly will have with the town if it's needed. I think from what I've seen and heard from some folks, I think that the town officials understand the implications of that and why that would not be in the best interest of the town to do that.
Town meeting is this coming Monday.
I understand.
Rich, real quick.
Yes.
If the letter of final determination for Plymouth County was issued in August, this past August, but there's corrections going on right now.
Okay, first off, there's two separate parts of Plymouth County. I'm only talking about the part of Plymouth County that is affected here. So the Buzzards Bay part of Plymouth County, not the other part of Plymouth County.
That's fine.
Okay.
So if the Buzzards Bay part of Plymouth County had its letter of final determination issued in August, you said there, and that locks in those maps.
It locks in the corrections to the old maps.
Yes, but then you said, but there are corrections that are underway right
No,
now.
So when I said underway, that just means that they're not finalized yet and effective. So they've actually done all of the revisions. They've been presented as preliminary maps, which have the opportunity to be reviewed. They're now being they will be finalized and will become.
I guess I used the wrong word. You said there are revisions underway right now for Marion, Mattapoisett, and Wareham to correct some inaccuracies. Will those be afforded the time, will there be a review period for those revisions?
What I'm saying, bad wording on my part saying they're underway, the revisions have already occurred. What's underway is the process of them being final and adopted and going into effect. So the revisions have already been made. The new maps with those revisions have been out. They've been under review, and they've been through all the formal processes other than being adopted by the towns. And they will go into effect on February 5th, whether they're adopted by the towns or not. So let me very quickly, I don't know if anyone's here from Gosnold, sort of, part of Dukes County. Current maps were effective in July of 2010. There are new coastal studies underway for all of Dukes County. Preliminary maps were issued back in June. But that process is currently not moving forward, and I'm not sure of all the details, except that I believe it has something to do with a question of how the tribal lands on the vineyard in Aquina are being represented. So that's one where we don't know how long it's going to take to resolve those questions, and we're most likely looking at those maps not going into effect in 2014, it would be in 2015. Okay, so having done that as background, I want to talk about the Biggert-Waters Reform Act of 2012. It's named Biggert-Waters as the two primary sponsors of the legislation. That's their names, Biggert and Waters. If everybody hears me say Biggert-Waters, they think, oh, there's bigger waters. No, those are the names of the Congress people. Was enacted by Congress and signed on the President on July 6th of 2012. And the intent was to make the flood insurance program more financially stable. The National Flood Insurance Program was designed to be self-sustaining, and that all of the premiums that are collected were intended to be sufficient to pay any claims that would come as a result of flooding and pay for the administration of the program. Unfortunately, as a result of some major flood events in the last few years, primarily Katrina and Sandy, the program is running at a very large deficit. I don't know the exact number right now. I think it's something on the order of $25 billion that the NFIP is in deficit. The way the program is set up, when there's insufficient funds from the premiums that are collected to pay for the claims, the NFIP has the ability to borrow that money from the Treasury and they have to repay it with interest. But because there's this substantial deficit, and there has now been for several years since Katrina, Congress felt there was the need to make some adjustments to the way that premiums are calculated in order to help the NFIP be able to try to make up that deficit. And one of the key things is they've looked at eliminating premium subsidies that are in place for certain classes of policies, and I'll go into the types of subsidies that there are currently in the system and how those are being phased out under the provisions in Biggert-Waters. And generally, with limited exceptions, the way that it does that is phasing in increases in the premiums over several years until the premiums get to what are called actuarial rates, the rates that are set up at a level such that you would expect for any property what you pay in for premiums would cover the expected claims that you would have over the life of the policy, over the life of the building. So there's two major types of subsidies in the program right now. One is for what are called pre-firm policies, and I'll explain what pre-firm is versus post-firm if you're not familiar with that terminology. And the second is for what are called grandfather policies. These are two separate, different types of subsidies that are being addressed differently by the legislation. These subsidies have been in place in the program for a long time. I think, if not from the beginning of the program, back in the early 70s. I know they've certainly been in place since I've been involved with the program beginning in the early 90s, and I think they go well beyond that. But Congress felt that these subsidies were an important factor in why the flood insurance program has been running a deficit, and it's something that needed to be addressed in order to make the program be more self-sustaining in the future. So, to talk about the pre-firm subsidies, we have to understand the difference between pre-firm and post-firm structures and how their premiums are calculated. So, firm, again, stands for flood insurance rate map, and a structure is determined to be either pre-firm or post-firm by looking at the date of its construction, or if it's undergone substantial improvement, then the date of that substantial improvement. And you compare that date of construction or substantial improvement to the date of the initial firm for the community, which are typically here either in the late 70s or early 80s. So for post-firm structures, where the structure was built after that first flood insurance rate map for the community, the premium that's calculated for that structure, for that policy, is based on what flood zone that structure is in. Is it in an X zone, which is outside of the 1% chance floodplain? Is it in the A zone, or is it in the V zone, which is the floodplain where you have high wave action and thus the highest risk? And then it's also based on a comparison of the lowest floor elevation of that building to the flood elevations, the base flood elevations that are shown on the map. The lower that lowest floor elevation is compared to the base flood elevation, the higher your premiums are, because you're expected to have greater claims. If you're above the base flood elevation, your premiums become lower, and as you go further up, they become still lower. Okay. For pre-firm structures, structures that were built before there were any flood insurance maps in the community, they're calculated a bit differently. They're only based on the flood zone that you're in. Again, are you in an X zone, or are you in an A zone and a V zone? Not the elevation of the structure. So a house that's just barely in an A zone, it's right at the fringe of the A zone, and your lowest floor, your slab on grade, it would have the exact same premiums as a house that's, deeply into the A zone. Let's say it's sitting right next to a river and it has a basement. Those premiums for those two houses will be exactly the same. In the case that I described where they're right on the edge of the floodplain and they don't have a basement, they may be able to, by getting an elevation certificate and being able to compare their elevation to the flood elevation, they may find that their premiums are better by calculating it by that elevation, and they can opt for what are called the post-firm rates, if that's a lower premium than the pre-firm premiums. Okay, so these pre-firm structures, they're all calculated essentially the same. When I say the rates are the same, the other factors that go into a premium, as with any insurance, are things like how much coverage do you have? Are you having $100,000 in coverage, or are you having up to the maximum of $250,000 in coverage? And what is your level of deductible? But outside of that, all the pre-firm structures in a particular zone all have the same, the rates are calculated exactly the same way. And the way that the program was structured, it was felt when Congress set this up that it would be unfair to people who built houses before there were flood insurance maps, before they knew what the risk was, to charge them true actuarial rates, to charge them what you would expect the cost would be in terms of claims down the road. So those rates have actually been subsidized. I don't know the exact amount. I've heard it's up to 40 to 50% of what the premium would be. And so those premiums are lower than they would be if you calculated the rates based on the elevation. And what Biggert-Waters Act said was, you need to start eliminating those subsidies. And the way that they're going to do it is they're going to take these pre-firm policies and they're going to increase the premiums by a fixed amount every year. It's 25% annual increases to the premium. And you do that until such time as those rates reach, again, true actuarial rates. What that means is that an individual won't know when their rates have increased so much that they would be better off going to those post-firm rates, those actuarial rates, unless they get an elevation certificate, figure out what their elevations are, and go to their agent and say, calculate my rates as post-firm rates, and let's compare it to the pre-firm rates. So those two cases that I described, the person that's right on the fringe there, they may already be better getting an elevation certificate and going to post-firm rates, or maybe in a year or two of these 25% increases. The person that's down along the river, they may go 5 years, 10 years better off taking that 25% increase, because if they calculate based on the elevation of their basement, their rates would be much higher. So what this means, though, is by and large, any of these pre-firm policies, I'll say only, it's a significant increase, but they're only facing a 25% per year increase in their premiums. The one exception to the elimination of the pre-firm subsidies that could be a dramatic change, but it's not, or dramatically high premiums, is any new policies after July 6, 2012, go directly to those actuarial rates. So let's say you had a house that was built in 1950. You never had flood insurance on it because you own the house outright. You don't have a mortgage. The bank doesn't require you, there's no bank to require you to get flood insurance. And now you decide, I'm going to take a home equity loan to help put my kid through college. You go to the bank, you get the home equity loan, they say you need to buy a flood insurance policy because you're in the special flood hazard area, and we're required under federal law to make you have a policy before we can give you this home equity loan. Now when you go to get a flood insurance policy because you've never had it, you'll need to get an elevation certificate, and they'll calculate those rates based on your elevations. That is largely the only case where you will see somebody going in immediately and going to some of the high premiums that you've been hearing quoted in the newspaper articles, the $20,000, $30,000, $40,000, $50,000 a year, with one other exception that I'll talk about near the end that's related to grandfathering. Okay. So I mentioned there's these 25% annual increases. The other thing that's a little bit tricky and confusing is they're not doing that for all pre-firm policies right now. They're doing it to just selected subsets. The first, and these increases, they don't occur. You've heard certain dates. This is going into effect January 1st. This is going into effect October 1st. That doesn't mean, let's say for the ones I'm going to talk about January 1st, where they started the increases for non-primary residences, and I'll define that in a minute. That doesn't mean that everybody in that category on January 1st got sent a bill that says your rates are going up 25%. What it means is when they have to renew their policy, every policy has a one-year term. Whenever their renewal date is, their first renewal date after January 1st is where they'll start getting that 25% increase. Might be January 2nd, it might not be until December 15th, depending on how their policy runs. So the first set of increases, or the first class of properties that are getting the increases, it's been in place now for several months, is non-primary residences. And that's not exactly the same as a secondary home, but it's close. The flood insurance program defines a primary residence as a residence where the insured is living in that home at least 80% of the year. Okay? So you have to be there, whatever that adds up to, 9 months, 10 months out of the year, you have to be in your house. If you're in your house less than 10 months out of the year, that's considered a non-primary residence, and that's subject to these increases that began on January 1st. What that means is, if you're one of these people that are fortunate enough, you have a house here, You have another house down in Florida. You spend half the year in one, you have to spend half the year in the other. Neither one of those is considered a primary residence under the National Flood Insurance Program. And if both of them happen to be pre-firm structures in the floodplain, you would be getting those 25% increases on both of them. But you know, that is the first class that Congress said they wanted to start phasing in these subsidies, phasing out the subsidies, excuse me. The second groups, which began on October 1st of 2013, are for non-residential structures, businesses primarily, commercial structures, and then structures what are called severe repetitive loss structures. And these are buildings that have had a minimum of 4 claims of $5,000 or more each. So they will also be facing these premium increases of 25% per year. All of the other pre-firm buildings, if they're a primary residence, and they're not severe repetitive loss, they're going to retain that subsidy until such time as a new policy is needed on that house for any reason. Generally, that would mean if the house is sold, if for some reason you let your policy lapse and then want to start it again. Let's say you paid off your mortgage, you decide the bank isn't requiring me to have the insurance anymore, I'm going to cancel my policy, and then a year down the road, you say, oh, I've changed my mind, I want the insurance after all. That's now a new policy, and you will lose that pre-firm subsidy and you'll go to actuarial rates. Okay, so that's the first category of subsidies. The second is what's called grandfathering. And what that does is it allows for post-firm structures, for structures that are have their premiums calculated based on their zone and their elevation, to have those premiums be calculated based on an earlier flood insurance rate map, not the current one, which can definitely be advantageous if the new maps are showing increases in flood elevations or are showing you going from a less hazardous zone to a more hazardous zone. Say you're going from an A zone to a B zone. There's 2 types of grandfathering. They're kind of related and connected. The first one is grandfathering of an existing policy. What that basically simply means is if you currently have a flood insurance policy, let's say your house is in an A zone, your base flood elevation is 10, you have a policy, your premiums are based on that zone and that elevation. You get new flood insurance maps, and you move into a V zone with an elevation of 15. As long as you maintain your policy under the grandfathering rules that have been in place, your premiums are still calculated based on that A zone at elevation 10. And again, that will maintain that grandfathering under the rules that have been in place through now. That grandfathering, that way the premiums are calculated, remains in place until the policy lapses. The second one, which is kind of related, it's called built-in compliance grandfathering. What's different about this is it doesn't require that there already have to have been a policy in place. But let's say you built your house in 1985, and at the time, again, you were in an A zone, your house was, your base flood elevation was 10 feet, you built your house in compliance with that zone and that elevation. So you elevated it so that the lowest floor was above that elevation 10. And your premium, you never had a premium, you never had an insurance. In the interim, your maps have changed, your house is now in the V zone, your base flood elevation is 15, and you go to get a new policy. If you can document that you were built under this map, it was A zone, elevation 10, through your building department records or whatever, your premiums can be calculated based on the map that was in place when you built the structure. as long as it was built in compliance with the map at the time. And that's very important because that's the second case where you're seeing a lot of these reports of people that have gone from $4,000 premiums to $50,000 premiums. In most cases, what I've seen is it's because of this, the loss of this grandfathering, because when they were built originally, they weren't built in compliance with the maps that were in place at the time.
What happens if you sell your house if you're in compliance?
Okay, if you are in compliance?
If you were in
Yes.
compliance.
Okay. I have to preface this by saying everything that I've described to you about the grandfathering process is the way that it has been historically, and I'm going to get into how Biggert-Waters is going to change that. But as of right now, the rules are still this way. In the case like you've described, you always had the ability to, at the time of sale, assign your policy to the new owner, and they would maintain that grandfathering. That's something in some of your communities when you got new maps in 2009, we came out and did meetings here. I think we may have even done one down here. That was something we stressed because, you know, you were able to, if you were affected by the map change and you had the grandfathering and were going to sell your house down the road, you could always pass that grandfathering along to the new owner. But you're going to have to hold that thought for a minute because now I'm going to talk about how Biggert-Waters is going to be changing this potentially.
But Rich, on grandfathering, you said grandfathering is only good until the policy lapses, and if the policies are good for only 1 year, isn't all the grandfathering
No, if you renew it, that's considered maintaining the policy in place. A lapse is if you don't renew it. You basically say, I'm not getting the insurance anymore. Okay. Now, Biggert-Waters has a provision in it that says we're going to phase out grandfathering. And it says whenever there's a map change that affects people's premiums, you go from the A zone to the V zone or whatever, you're going to have a 5-year period, a 5-year phase out where you move from rates based on the old map to rates based on the new map. That is what Biggert-Waters says, and that's what the NFIP is working towards. But doing that requires setting up all sorts of rules and procedures on how it happens, fairly complicated rate tables. How do I do this phase out over 5 years? Because right now, when an agent looks to figure out how to calculate the rates, they look only, is it A zone, is it V zone, what's the elevation difference, and they calculate the rates. When you move to this, it's going to need to be, well, I'm going from an A zone that's this to a V zone that's that, and I'm in my 3rd of 5 years. How do I calculate the premium? So it's pretty complicated, and they're having to develop all of these ways to calculate it. So right now, the current target date for phasing out the grandfathering is October 2014. But right now, grandfathering is still in place. So anybody that's affected by these map changes that are going to occur in June, let's say, you're still going to have this grandfathering in place. If you're going from the A zone to a V zone and a map change in June, you will still maintain those A zone premiums until such time as this phase out begins, whether it's in October 2014 or whenever it actually starts happening. Okay, there's one other thing, it's not on the slide, and I'm actually going to have to look at my little reference guide to make sure that I've got it right. I believe, yeah, any transfers of properties where you go to assign the policy to a new owner, if it's a post-firm policy like I've described, you can still transfer it and you can still maintain the grandfathering. If it's a pre-firm structure and it's the pre-firm rates and the pre-firm subsidies, When that policy is transferred, you lose the subsidies. So it's very complicated. That's why I tried not to go through all the details in the presentation. But look at the little cheat sheet in there. That will hopefully give you your answers about specific cases. There's one last thing. It's kind of grandfathering, but the NFIP is pretty strict about saying don't call it grandfathering. I'm not really sure why. But there's something called the preferred risk policy, which is a lower cost policy for structures that are not in a special flood hazard area. So they're not in an A zone, they're not in a V zone, they're in an X zone. The annual premium for this preferred risk policy is around $500 a year for maximum coverage for the 250,000 building coverage, $100,000 contents coverage. If you're mapped into the special flood hazard area by a map change, so in other words, you were in a zone X, and now the map change is putting you into the special flood hazard area, into an A or a V zone, you are eligible to get this preferred risk policy under a provision that's called the Preferred Risk Policy Extension, or we call it the PRP extension for short. As this was originally set up, that extension was to be for 2 years, and then you would go to standard, I'll call them actuarial, standard X-zone premiums. But what's happened is, as part of all of this change of the Biggert-Waters and figuring out how to calculate all these rates, and a provision that was increasing certain of these preferred risk policy premiums by 20% per year, they've basically said, the FIP has said, we're leaving this PRP extension in place for longer than 2 years until we work out all the details on how to phase that out as well. So right now, similar thing, we're telling people if these map changes that occur in June, let's say, if those map changes put you into the special flood hazard area, talk to your agent about getting the preferred risk policy extension, and you'll be able to maintain that for some amount of time. We can't tell you how long. It's going to be 2 years, if it's going to be longer than that.
If you're in the X zone, you're not required to get flood insurance, right?
Correct.
So that's just a voluntary program.
Right, because they throw the statistic around a lot. Somewhere around 25 to 30% of all claims in the NFIP are outside of the map flood zones. They're in the zone X. Whether that says something about the quality of maps, I'm not going to say. But so, that's an overview of the rules. I have to say this because I've been burned in the past by coming and telling people what the rules are, and then the rules change, and they say, you told me it was X, and now it's Y. So, everything I've presented to you today is based on the laws, policies, and procedures that are in place today. This is a very flexible situation. They're coming out with new procedures, new policies regularly. Congress is looking at several bills that would delay the implementation of a lot of these provisions. In fact, I mentioned that it's called the Biggert-Waters bill. Maxine Waters, who's one of the sponsors of the bills, who was the sponsor of the original bill, is the sponsor of a bill that would delay the implementation of this, because she says she never expected that these increases would be so dramatic and so painful. So stay tuned. You know, I don't want to come back here in 2 years and have you tell me, oh, you told me. I've had this happen already. We came out in 2009, told people about grandfathering and all the reasons to do this, and I had to come back and say, well, grandfathering isn't working the way I told you a couple of years ago. So that's sort of it in a nutshell. For more information, there's a website where FEMA has all of the information on Biggert-Waters, and I'm happy to take any questions that we haven't addressed thus far.
Rich, you gave some examples of insurance policies and costs, and I've seen various numbers, and then I see in the newspaper someone talking about like an increase of $40,000, and I said this is going to be a typographical error. I mean, what are some typical policy costs that we're seeing for single-family homes in the flood zone?
Okay. I'll start with the average premium in Massachusetts currently is $1,200 a year. That's up pretty significant when I'd say even like 5 to 10 years ago, that average premium was down around $700 or $800. So there's just been this kind of escalating of premiums over time, either because homes are worth more, people have more coverage, or just because of the need to increase the premiums. I'll say a typical pre-firm A-zone building with full coverage, again, $250,000 building coverage, is probably somewhere on the order of $1,500 or so. That's before you have any of these 25% increases if you're in one of those categories. A typical V-zone pre-firm policy with full coverage could be somewhere in the $3,000, $4,000 range. In almost every circumstance where you're seeing these $20,000, $30,000, $40,000, $60,000 premiums, it's because of one of these triggers that I talked about. Either it's a brand new policy, which means they're going straight to the actuarial rates, and it's because of a major, you're in a V zone with your lowest floor 5 feet below the base flood elevation, or something of that sort of thing.
Those numbers don't make any sense in terms of the frequency of storm and the value of the structure.
I hear what you're saying, and I sort of look at that and say I don't know. If you think about it though, if you think that you're that far below the base flood elevation and you're in a V zone, you would think you would be facing dramatic costs on a regular basis.
Right.
Which would say, if you're not seeing that, again, does that raise into question the maps that are producing these figures? Does it raise into question, I'm not an actuary.
Well,
so
it's the actuarial table.
When actuaries sit there and they say, this is our claim experience, because they go through, thousands and millions of, I don't know about millions of claims, thousands of claims over time. They look at where the building is, how does it compare to the flood zone, and they look at their experience of claims, and based on that, they do their little calculations and they crunch the numbers and say, this is what the premiums need to be, and then they build in, we need so much to administer the program and so forth, and they come up with the rates.
Yeah.
To me, it's magic. Okay?
Right, I know. To me, if you have a structure that it would cost $300,000 for someone to rebuild it, and it's right there on a coastline, maybe a few feet above, and it gets, if you collect $60,000 a year, in 4 years you've got the full cost of the...
Well, you said several feet above. That's the thing. It's not several feet above.
No, I meant several feet above sea level. I'm just
right.
saying it's right on the water, and you're 10 feet below the velocity zone base flood elevation. Even if it was destroyed every 5 years, you're covering the cost at those numbers that you're quoting.
I can't say. I do sometimes look at those actuarial rates and question, are they truly actuarial? But that's that's hard to say. Any other question? Yes.
Question. Is the maximum insurance you can get is $250,000?
Under the National Flood Insurance Program. For residential structure, it's $250,000. For non-residential, it's $500,000.
And is there an additional 100 for contents, or is that?
It's 100 for contents additional. Yes.
I know that was included in the 250 or.
No, they're separate. They're separate coverages. You can opt for only building coverage, or you can get building plus contents.
Okay.
As you choose. You have another.
Well, along the lines of what Joe was saying, then use the example, the most you can get is $350, $250 for the building and $100,000 for contents. If someone is right on the ocean,
right,
and their first floor elevation, just use his example, 5 feet above sea level and the B zone is 13 or 15
Right.
or whatever it is in that zone. As he said, in 7 years, at 50,000 a year, you cover the expense. Now,
Yeah. But I will tell you,
when
if
you
there
have
are,
houses one after the other, I mean, you don't have a Sandy every 7 years in every part of the coastline from Florida to...
no, but I can tell you, I've seen structures with claims history where you go and they had $50,000 in damage this year, and then they had $100,000 in damage 2 years later, and they had enough. Again, maybe not to be $65,000 every year, but certainly to have $15,000, $20,000 a year be the expectation of what the claims would be. I've definitely seen that. I won't name community names, but some of them are not too far from here, in fact. So, I'm not, again, I'm not an actuary, so I can't say whether those premiums are appropriate or accurate or not, but, because as I said, some of them I look at and I say, this doesn't seem to make sense, but I don't know the details.
You didn't mention repetitive structures, but there's a trigger in Biggert-Waters too for repetitive.
I did mention.
Oh, yeah, okay, maybe
Yeah.
I was on that.
That's one of the triggers for the 25% increases is if you're a severe repetitive loss structure. Yes.
As far as you mentioned earlier that there's some potential legislative changes in the works, from what you know or from what you've heard, where does that sit? Is that something that's being dealt with like immediately as we speak, or is it something that's sort of being considered but not that important right now?
I heard a legislator say recently they're wanting to look at it, but right now they're dealing with some major things like a budget and like Syria and some other things. So I saw something that said they may be taking it up in the next month or two, but I will tell you up front, trying to speculate what Congress is going to do is a really risky business.
Right.
And I don't know when, I don't know what it will be. Will they decide to, they could push it back a year, they could push it back 5 years, they could eliminate certain provisions. There's like 6 or 8 different bills that are currently in place to be considered. So what that's going to look like is anybody's guess. One other thing that you see it mentioned a lot in the articles is one of the provisions of Biggert-Waters was that there was to be an affordability study done for the NFIP and for some of these changes. And that is something that was directed to be done, but it wasn't, the premium increases weren't tied to that occurring. So the premium increases were going forward while they were initiating this affordability study. It's a major issue. There's 2 competing things at play here. Basically, one is how do you make the insurance program self-sustaining so that the premiums that come in are sufficient to pay the claims. But the other is how do you maintain the insurance that people need to be affordable. And a lot of these provisions and these increases, I think were done with a thought of what these properties were and what they look like and what the people who own them are, that they're finding is not necessarily always true. I get calls regularly from people that say, I'm retired, I'm on a fixed income, I own my home outright and that's my only real asset, this is my retirement, and now I'm facing these major premium increases, even if it's only, I say only, going from $2,000 a year to $5,000 a year. That's something that these people can't handle. And it's easy to, in a blanket, say, well, people shouldn't be living here, people shouldn't be being subsidized, but when you get down to applying these sorts of things in real life, it's never that simple and straightforward. So that's what I think Congress really has to wrestle with, is how do you maintain that affordability? Do you go to some, people have talked about maybe there's some means-based approach to provide vouchers to people that can't afford the insurance or whatever it might be. But I think ultimately you're going to have to see a mixture of changes like this and provisions to maintain the affordability. And as to what that will look like, that's anybody's guess.
Richard, how does a resident know what their insurance is being based on? Meaning, or how does FEMA know this particular house has a foundation at X elevation, this type of foundation?
Yep.
So are they just assuming the worst case and sending out the bill? It's up to the resident now to provide the data to have that bill adjusted?
When you get your policy, originally, you go to your agent and say, I need to get flood insurance. They'll look at where you are. You'll fill out certain things. It will describe where I am, when was my house built, what's my occupancy, is it primary, non-primary, and so forth. One of the first things they'll look at is when was the house built, and they'll compare it to the firm and say, are you pre-firm or post-firm? If you're post-firm, they'll come back and they'll say, you need to give me an elevation certificate that provides me the information for me to calculate those premiums. So I need to know the elevation of your lowest floor, I need to know the base flood elevation, I need to know X, Y, and Z. And that's what they'll use to calculate those post-firm rates. If you're pre-firm, they've never needed that because it's only based on the zone. So all they need is a determination. There are certain companies that do these flood zone determinations. And that's all they need. They need a letter that says you're in A zone, you're in a V zone, you're in X zone. And they can calculate the premiums based on that. One of the tricks in all of this is, and I kind of mentioned it, if you're a pre-firm, you've had a policy, you've never had an elevation certificate, they've just been generating this number, and now you start seeing these increases. At some point, you're going to want to get that elevation certificate to calculate what are my premiums getting out of the pre-firm side and going into the post-firm side. And until you do that and take the numbers to your agent and have them run the numbers, you don't know which way is better.
You use the term basement, but could you just clarify that term? Are you talking about the top of the foundation or the floor of the basement?
It's the lowest. The lowest floor is what always determines how the premiums are calculated. The lowest floor is one of my favorite definitions in the NFIP. The lowest floor is the lowest floor of the building unless you have an area that is not a basement, and under the NFIP, an area that is a basement is an area that's below grade on all sides, regardless of the headroom. So if it's not a basement, so it means it's at or above grade, it's used only for building access, parking, and storage, and it has openings to allow the flow of water in and out. If you have all of those provisions, then your next higher floor can be the lowest floor. But if you have a true basement, then that basement slab is your lowest floor elevation.
And on the floor, do they measure from the top of the floor or the lowest horizontal member supporting the floor?
Depends A zone or V zone. In an A zone, they use the top of the floor. In the V zone, they use the bottom of the lowest horizontal member that's supporting the floor.
And then it gets tricky when your top of your foundation is outside the flood zone, but then your basement theoretically is below the base flood elevation.
Whether you're in or out is based on the ground that's adjacent to your
Right.
building,
Okay.
not the floor or anything else. Yes?
Do you know if the actuarial rates are actually known or are they a moving target?
They are wow, that's a great question. Actuarial rates are known. So there are rate tables that say
A zone, lowest floor, 2 feet above the base flood elevation, you calculate it based on this. It used to be that anything that was 2 feet or more below the base flood elevation, that lowest floor is 2 feet or more below the base elevation, they went to a separate thing called submit for rate structures, and the agents didn't have the information to do the calculation. They had to send it off to NFIP, and NFIP would come back with the number. But NFIP recently released, I think they call it specific rate guidelines or something like that, and that shows how they do all of those calculations. It's much more complex. It has to do with what's down there. Do you have utilities down there? Do you know, and a number of other factors. So they put it out in the interest of transparency, and then it gave all sorts of warnings that said you need to understand all of the specifics about how this works in order to calculate a rate. But they are out there, and if you are interested in looking at them, I can send you the link of where that can be found.
Yes, we'll go back to where we started. First question is my own information for next Monday. The insurance part of this program is run by the insurance companies themselves, or does the federal government run the insurance?
It's run by the federal government. The National Flood Insurance Program is run by the federal government, but they work with the insurance companies where the insurance companies write the policies, they collect the premiums, they adjust the claims. But the premiums all go into the National Flood Insurance Fund, which is run by the NFIP. That's where the premiums come into. That's where the claims get paid out of. So the insurance companies, they're basically doing all the paperwork, but they're not the ones that are taking the risk. They're not the ones that are setting the rates. They're not the ones that are, you know, the claims are not coming out of their pocket, if you will. And they're earning commissions for doing this.
So they're getting paid for the administration?
Yes.
The question we go back to, I started the meeting, town meeting on Monday.
Yep.
You've already got a letter basically from the state saying if you don't accept, they gave us 5 or 6 pieces to the puzzle. But what you said earlier was that whether we accept or not, they go into effect February 12th.
They go into effect for purposes of things like the state building code, for things like the Wetlands Protection Act regulations. But if the town does not adopt those new maps as part of their bylaw, the town would be suspended from the flood insurance program. There would be no longer eligibility for flood insurance, to get flood insurance for any residents of the community. That would make it incredibly difficult for anybody who's within the map flood zones to get a mortgage or any loan of that sort. There's also certain types of disaster assistance that would not be available to the town anymore if they're suspended from the program.
So any town, we have to have 2 town meetings a year, but any town that has an annual town meeting, that's it, is going to have to go to a special town meeting because of the time frames.
Well, if you look at the dates, as I've gone through things, we work with FEMA and we work with the towns to make sure we try to, sync up any map changes to tie into town meetings effective in June or July, so that we've got that window of 6 months to sync up with the town meetings, the spring town meeting schedule. It can be tricky sometimes because town meetings aren't always the same time, and if you get in a large county, you might have some as early as March and some as late as June, and you really have to do a lot of coordination to figure out everybody's days and get the dates to line up. But that's the way that we work it.
Just to follow up, Rich, I was very concerned when you said that the folks that were at the special meetings that you've had so far, the tendency is to want to, almost lash out and say that we're not going to accept it, and that tendency is starting to grow. And I think back to the articles that are coming through in the newspapers, and they focus on that $40,000 or $50,000 increase, which in reality is about a 95% chance that the building official at the time of the construction of that home possibly erred, and the structure got built, and it should have been at a different elevation. It should have been at a much higher one. But when you think about a community that might want to remove themselves and not accept this, think about the private side of it, and I've had the opportunity to speak with a few owners of insurance companies, and it's interesting to try to note that as soon as the community backs out of accepting the NFIP, you now, as a community, you are not eligible anymore for disaster assistance. And that could be snowstorms, it could be anything that comes along. So the community now, as a whole, will not be able to receive any money from the federal government during a disaster. And then if you look at the individuals that are in the floodplain, and obviously the town of Wareham has a considerable amount of floodplain areas, the people that have mortgages now are not in compliance with what the mortgage companies hold and run the risk of the mortgage company and first, second, and third mortgage companies, in some cases for folks, can call the note because they're not in compliance. And then lastly, the numbers that I'm hearing from the insurance company owners are anywhere from 30 to 60% higher than the NFIP rates to privately insure your property.
Yes.
So, to me, sir, you need to try as a municipal leader.
It's already been, everything you said
Yep.
was explained in public hearing.
Awesome.
What's
Just give them both sides,
You know, but what's happened is, people today, and this is in politics, they don't trust the government, they don't think the government represents them. They feel this has been, this is what they call another unfunded mandate, which has been thrown on them with no time to respond. They ask us, why didn't you appeal, why aren't you doing it? We didn't have any time to do it. They want to hear it. Join the lawsuit, they want us to join the lawsuit with Situate and Marshfield. The attitude is, we explained what the potential problems were. They don't care. And on a town meeting floor, you get 300 people come in, and someone sits there and goes off the deep end with a passionate speech, they're going to vote probably to put it off and not make a decision. There's a good chance of that this coming Monday.
Yes.
Because I just want one thing. It's two separate pieces.
It is.
One is the maps and one is the bill.
Absolutely.
The problem is the bill, which I can't get through to people.
Right. Abe, you're absolutely right. The only other thing I want to say is 99% of the time, I would say, when you see these articles talking about these major increases, they're not due, as of right now, any changes that people, any increases like that that people are talking about now, they're not due to the map changes, and they're not due to this bill yet, because the map changes in most of the communities where you're reading about this have not gone effective yet. And the premiums are based on the map that's effective, not the map that's maybe going to become effective next summer or whatever. So if you read about issues and people in Marshfield that are getting $50,000 premiums and they're saying it's because of the new map, that's not the case because they don't have new maps yet. If they're talking about it being because of the bill, well, I went through most of the provisions of the bill are 25% increases. There's nothing that says you go from $4,000 to $40,000. So, almost every circumstance where you read those articles, there's something else behind that increase that you're not hearing, because in people's mind, people connect what they hear about to what's happening, whether they're really connected or not. They've heard there's a bill that's increasing premiums. They get a bill that's going from $4,000 to $40,000. They connect it to whether they're really connected or not.
In our case, just as a reference, the previous map which we were working on, we had a lot of properties that moved at a higher rate. In Wareham in particular, I live on Oak Street, which is down the road, and I'm about 70 feet up in the air from sea level there. And we were in a flood zone. With the new map that we have to adopt, I'm out.
Right.
But all I'm saying is we explain to people that this map will help most people.
Most of your changes are removing people, are reducing the flood zone, and this setup go around, not the other way around. So I think that's the other thing is people aren't right. It's the last set of changes that was bringing people in, not this set of changes.
Well, that's where these cost increases are coming, because they're working with those maps. We have, as I said, Swiss Beach, which is a low, I'm going to say low income, but it's a medium to low income area. a lot of homes tight together. Obviously, they're all in a flood zone. And we've had, a week ago, there was 5 or 6 homes put up for sale because people don't want to pay what the increase on their flood insurance is going to be. And we did have one extreme case where $1 million plus home, because that would be a new policy. The deal fell through because the insurance was going to go somewhere between $40,000 and $60,000. I couldn't believe someone could pay $1 million for home, can't pay the insurance, but the deal was canceled out for that.
The other thing you may find on things like that is because the NFIP only provides $250,000 in coverage, they may be talking about private coverage. And I will tell you, even with all of these increases that we've been talking about, what I've been hearing is that the private coverage is much more expensive if and when it's available. There are very few companies that write it, and the cost is much higher. And just as an interesting little note, I was doing a presentation at the Mass Association of Realtors recently, and somebody asked a question about, well, if the NFIP, let's say the NFIP is eliminated by Congress, because there are people in Congress that are saying, why is government even involved in this? Would private insurance step in to take it over? Somebody from the insurance industry said they had heard from somebody that's involved in this that private insurance would be interested in providing flood insurance to people, but not to people who are in risky areas. So that's sort of the way insurance as a private enterprise is to make money, and that's what their goal is, to sell insurance to people who aren't going to file claims or who are going to file minimal claims.
Isn't that how this came about in the first place?
Yes, exactly. There was not private insurance available, so the idea was that the government had, in order to reduce the reliance on paying disaster assistance during an event, would establish this insurance program to be self-sustaining, to collect the premiums, and to be able to pay the claims on a regular basis, as opposed to having to deal with it in a post-disaster situation. And as a note on that, I took a recent vacation up in Canada a couple of months ago, and Canada has no national flood insurance program whatsoever. They had a major flooding in Alberta. They had like $6 billion worth of damage. There's no government flood insurance program. There's no private insurance that covers flooding. They are dealing with a huge, massive problem of how do they come up with ways to deal with the $6 billion of losses in a recovery phase, and it's a huge issue. And that's essentially what you'd be looking at if you didn't have an NFIP.
Rich, you want to give a quick plug to the Buzzards Bay NEP and CZM for helping identify those map errors?
Oh, absolutely. You pretty much said it, but basically, when we had the map changes in those 3 communities that I was talking about, Joe's group had been doing some work on identifying the potential effects of climate change and sea level rise to those communities, and in looking through some of the background information, the LIDAR and some of the other information, noticed that there were some discrepancies in how those delineations were made, brought those to our attention, and we provided that information then to FEMA, and that's resulted in a lot of these corrections occurring in those 3 communities. And we hope to be working with you on some of those other corrections as well.
Rich, obviously this is happening because of Sandy and the Katrina and the amount of money that was paid out.
Mm-hmm.
In states where they don't have the repetitive loss, like we saw in there, I've heard that there's a move for states to try to insure themselves. And what would prevent a state from doing its own flood insurance program? And if a state were to do that, would that then jeopardize their participation in disaster relief at the federal level and whatnot?
A couple of things related to that. It's a fabulous question, by the way. One of the reasons that you have the National Flood Insurance Program was that, in general, insurance works best when the risk is spread out broadly. And in fact, if you look at major private insurance companies and how they deal with, say, homeowners insurance, one of the things that they do is they go out and they purchase reinsurance from major international corporations, because you want to have your pool that you're drawing from be as broad as possible and have your risk be spread as far as possible. The problem with flood insurance is that, unlike, say, homeowners insurance, where maybe, a house is going to burn down here or something's going to happen there, with flood insurance, when it happens, it tends to affect a lot of people in an area at the same time. And if you have a Sandy, if you have an Irene is a perfect example of this. If you think about Vermont, okay? Vermont was one of those states that was for years and years saying, we're paying all this money into the flood insurance program premiums, we're not collecting. We've paid 100 times more than we ever collected in claims. And then Irene hit Vermont. Massive, massive damage. They're now in the category, on the higher end of the spectrum of how much has been paid out to them in claims as compared to what they paid in premiums on the basis of that one event. So if they went to a state flood insurance system, let's say, you're collecting the premiums from within Vermont, and then you have an event like Irene, how do you pay the claims? Unless you've gone and paid for reinsurance somewhere else, there's just no way to do it because you don't have the pool to cover it. One of the things that was being looked at in terms of ways to reform the program, FEMA had a group that was working on reform alternatives that came up, that was in the process of developing recommendations to Congress. And one of the things they looked at was the state programs or something like that. And they said it might be something that would be feasible, but you have to have a way of tying it all together and getting these reinsurance mechanisms and so forth, or else it wouldn't work. A state really can't go on it alone because of the way flooding works. Right now, the way the NFIP is structured, there's really no way to, you have to basically withdraw from the flood insurance program in order to do this. There are some provisions when you look at availability of disaster assistance and some other things. There are ways that can be provided if you have insurance in place that's comparable to the NFIP, so they don't require necessarily NFIP participation and coverage, but you need to have an equivalent insurance system in place. So in theory, maybe a California could do something like that, where you have the broader thing, and if you have, floods in Southern California, you're not probably having the big floods in Northern California too. Maybe there's enough of a, diverse pool there where you could do something like that, and you could set up a state system. But I think in general, it wouldn't work.
Has there been any discussion when you consider the repetitiveness of some of the neighborhoods to not allow rebuilding?
Now, there's a couple of things. One is there's a current requirement that says if you're substantially damaged, you're damaged more than 50% of the value of the structure, if you're going to rebuild, you have to rebuild to the standards of the map that's in place, which presumably would provide a level of protection. In some areas, we don't have this in Massachusetts, but in some other parts of this country, in some communities, they've established cumulative substantial damage requirements where you add up. So if you had 20% this year, and you had 20% next year, and you had 20% again 3 years from now, you add those all up, that gives you more than 50%. You have to elevate based on that.
Is that a state decision or a federal decision?
That's a state or a local. It could be a local decision, except that in Massachusetts, we have a uniform building code, so that a community cannot adopt building code type standards that are stricter than the state code. But the state, if the state through the BBRS wanted to put that kind of a provision into the code, they could do so. The experience I've heard from places where they have it is it's a nightmare to administer, just in terms of the record keeping and how do you deal with changes in value. You know, do you tie it to the current value? Do you tie it to the value at the time the claim was, the damage occurred? It's really, it's something that's logistically very difficult to put in place. One thing that's interesting is that Biggert-Waters, one little known provision of Biggert-Waters is it set up a new definition of substantial improvement or substantial damage, which I think was 30%. It was in here was only directed to go on the insurance side, but it's thrown everything into a tizzy because you can't really, again, and how, in terms of how do you administer this, could you have substantial improvement be 30% for insurance but be 15% for construction and compliance? Or would you have to change? Now, if they're going to have to change that for the construction requirements, that requires rulemaking and federal regulations. Every state would then have to go and amend their building code, or if they use the international code, you'd have to amend the international code. So that's something that I'm sure the FEMA people are working on, figuring out how and when you implement this sort of thing. So a lot of times when you have legislation like this, there are provisions that take a long time to work out all of the rules and regulations and policies and how you put it in place. And that's kind of one of them.
Rich, just a quick question. In a V zone, you have a house that's pre-firm, and you want to add a lateral expansion, a bedroom addition that does not exceed 50% of the value of the house. I have a chart from a few years ago where you gave us seminar in Harwich, I think. Does that addition have to be on elevated on open pilings? So you got a cape that was built in 1750, and Mrs. Smith wants to put a master bedroom on. That's at elevation 14? Okay. I just wanted to, because people have asked me, and I said, wait, that can't be right. I mean, but that's what the chart says, so.
Use the chart.
Okay, that's what I thought. Thank you.
I don't know how we're standing on time. If we have, I mean, I'm able to take as long as people need, but if you've got...
Yeah, no, if others have questions and we have time.
You have my contact information also. If you think of something, you know, this afternoon or tomorrow or next week, happy to send you an email, give you a phone call.
Just one other case that came up. Someone built a house up 15 feet up, because that was, at the time, that was the standard. Now with the newest maps out, et cetera, it's 18 feet.
Yeah.
What do they do? Because now they're going to get penalized and they've already spent the money. To move that 3 feet higher up is not a little bit of money.
Well, right now they're not going to be penalized because the grandfathering is still in place.
But
When and if, or whenever, I don't know, 2014, 2015, whenever that happens to phase the grandfathering out. And it's not clear whether phasing the grandfathering out is only going to be for map changes, future map changes, or are they going to go back and look at existing grandfathering as well? I don't know. It may be something where it's several years down the road. It may be something, but you're absolutely right. It's not inexpensive. I will say that there are grants that are available from FEMA through the hazard mitigation grant programs for elevating homes. I think there's going to be a lot more interest in now that we've had some of these provisions. They have to be applied for by cities and towns. Individuals can't apply for the grants directly. But if you want information on those grants, you can send me a note, and I can provide you the information on those as well. Thank you.
All right, thank you.